Good morning, everybody. Today is January 16, 2015. My name is Ricardo Menjivar. I wish to welcome you to Phoenix Trading Strategies, where strategic knowledge and information that allows you to trade successfully. Let's go over the disclaimer before we continue. There's a lot of information we have to cover today. Future stocks and spot currency trading have large potential rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the future stocks and forex markets. Don't trade with money you can't afford to lose. This website is neither a solicitation nor an offer to buy, sell future stocks or forex. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. Past performance of indicators or methodology are not necessarily indicative of future results. For those of you that are here for the first time, I would recommend that you read the website, go over the blog. You can look at our trading indicators, read about us. You have some information on myself. I'm sure that some of you have. If you go to the blog, you can actually see some of the videos that we have. Go to trading videos, latest trades. Realistically, didn't trade these past 2 days because I stayed out of the market. Thank God. So, but it's important, for you guys to get very familiar with the information that you're being provided here, because it is cutting edge and state of the art. But today we're going to talk about something that's much more important that affected all of us, and it has affected a lot of the whole retail FX market world, the FX market in general. The decision by the Swiss bank, the Swiss central bank, to basically remove their peg from the euro without notifying anyone really has caused what we call a protectionist ideology on their part, and it's understandable. The euro right now in general is in trouble, and they were sustaining it. So by them basically pulling the plug and allowing the Swiss to free float against the euro, it basically caused a traumatic effect in the market, what we call a carnage. This is a repeat of what happened in 2008 with the subprime mortgage losses that Wall Street had. It affected the global markets on a worldwide scale. There were no parachutes, and everyone lost tremendous amounts of money. That's exactly what has happened to a lot of forex traders out there. They have lost their money, their accounts. This, of course, is now going to limit the pool of broker dealers to do business with, and it puts everyone in a position where you have to be very cautious of who you do business with now, and that's something that's very important. But aside from that, it has created tremendous opportunity for us, and we're going to go over that. Now, I know that many of you are here because you want to know, did the software pinpoint these trades before they actually happened? The answer is yes. It identified these trades it identified the US Swissy, the pound Swissy, and the Euro Swissy literally an hour and a half before the trade actually happened. And I'm going to go over that with you, because it's important nowadays to really use technology that will set you apart, especially now. We are in a situation where central banks have just entered what I have always called a currency war. And it's a war of protectionism. It's a war where basically they're looking to protect their own interest. There's only 3 central bankers in the Swiss Central National Bank. Only 3. Why did they do it on Wednesday? Why did they not notify anyone? Because, number one, they knew that if they did, it would allow everyone to basically get an advantage. So what they did was they basically threw the first stone, knowing that it would protect their interests first, not caring how it would affect the market or how it would affect the retail trader. It's business, it's not personal. I'm sure that some of you may have lost money, some of you may have made money. I spoke with a lot of friends inside the industry to see who's in and who's out right now. A lot of changes are coming, but at the same time, a lot of great opportunity to trade will present itself for those of us that stayed out of the carnage and are now ready to go into the trade. So this is very important because we're going to be discussing a lot of strategies today, and we're going to be going over who's in and who's out in regards to what they call the carnage of the Swiss National Bank. So there's two brokers right now which are basically in danger. FXCM is in trouble. For those of you that have accounts with FXCM, my suggestion is you request your money now. Reason for it, they had $225 million negative equity balance based on what happened. Excel markets in New Zealand basically is out. Alpari markets is out. They're done. Okay, they cannot continue to do business. Fortunately, they had their clients' funds in segregated accounts. However, that doesn't signify a lot. Here in the U.S., there really isn't, there aren't segregated accounts in FX. And so it changes the whole dynamic for us as retail traders. So as much as they'd like to say, you know, that this game isn't rigged, it's rigged. There is inside information in and out. The only thing is that the Swiss National Bank did not decide to let everyone in on their little trip, unfortunately. So my suggestion is that based on the situation that FXCM is going through, if you have an account, my recommendation for the time being is pull your money. Pull your money and be safe. Don't be sorry. These are the comments that FXCM made. It says, as a result of these debit balances, the company may be in breach of some regulatory capital requirements. We are actively discussing alternatives to return our capital to levels prior to today's events and discussing the matter with our regulators. Look, I was a broker at PFG, and when Wassendorf decided to basically pull the plug on us, there was no tomorrow. A lot of my clients, I had 1,000 clients, and they all got hurt. This type of statement does not give anyone confidence. This type of statement tells you it's time to be safe, pull your money. If by any chance FXCM, does meet the capital requirements that the regulators have imposed on them right now currently based on this loss, because this is a tremendous amount of loss, you have to understand that what has happened right now in the market is that a lot of retail traders owe money. It's a debit. Now normally, when you're trading FX, you're basically just margined out. However, in a move of this category, that doesn't happen. A move of this category basically puts you in a negative position to owe money to your broker-dealer, and that's not good. That is not good. Now, if you can't pay it, they're responsible for that loss, because the way it works is that they have liquidity providers that they are responsible to. You having a retail account, if you have a loss, normally you belong to their B-book. Now with their B-book, that basically means that they're taking the opposite side of your trade. If you're in their A-book, they're doing straight through processing. So what happened in the industry was that you have two types of mechanisms, and never before, not in the last 20 years, have we had the Forex market globally freeze for 1 hour. What happened here is that the decision by the Swiss National Bank to throw this bombshell into the works froze the global foreign exchange market. And that's a terrible thing, because that means that we cannot really assess the total losses that have occurred. We are barely starting to see who is going to disappear. IG markets took a 30 million pound hit. 30 million pound hit. And right now, they are currently in the process of basically buying out other broker-dealers and taking their client base, because the pool of liquidity providers, the pool of broker-dealers has begun to shrink. Not that many of them out there survived this. A few of them even made a ton of money because they were hedged correctly before this thing exploded. Now, unfortunately, a lot of clients, retail clients, didn't see this coming. And that's why I'm addressing this, because it's very important for you to understand what is happening worldwide right now. There is a huge adjustment. My friends inside tell me that the companies that made money, the broker-dealers that made money, are actually forgiving the debits to their retail customers. However, the companies that lost money, like FXCM has not come out with a statement saying that they're going to forgive that money. In no way have they come out with a statement. Awanda here in the U.S. has come out with that statement, saying that they are going to forgive their customer accounts, those debits, and open positions they're going to honor for those that were trading the pound Swissy, the US Swissy, and the Euro Swissy. So when someone comes out with that type of news, then basically you look at it from the perspective that it's very important to understand who's strong and who isn't. And what's happening is that if you're, when someone says that right now, and someone doesn't make a statement like that, then it sort of puts you in a position of, where do I move? Now, we haven't heard statements from a lot of broker-dealers. A lot of broker-dealers are still staying on the sidelines. Everyone is begging right now for Friday to end. And the reason they're begging for Friday to end is because it will allow them the time to actually calculate the damage, assess the damage that they are facing internally with their own capital requirements. A lot of firms out of New Zealand are going to explode out of the market because their capital requirements were only meant to be $500,000. That's all New Zealand required. Australia the same. Australia didn't require more than, I think, 2 million on their end. So, however, there were firms that were well capitalized, that had hundreds of millions of dollars, in their chest, and so they weren't really affected by this. On the contrary, they also made money. There's a firm out there that I cannot disclose that actually made $250 million in one day based on what happened. Not because they knew what was going to happen. It's because of the information that they had and how it was being relayed. They had the right risk management tool that allowed them to actually position themselves correctly so that they would not lose money. So what you're facing now is that you're facing probably one of the most important moments that we're ever going to see again in the FX markets. Now, the difference here is that unlike in 2008 when the subprime mortgage hit, no government is going to come out and bail out the FX dealers. no government is going to come out and bail out the retail traders. No government is going to come out and say, you know, we need to rebuild this industry. That's not going to happen. Unfortunately, a lot of people that have money out there in the markets or that were exposed at the time, they were getting margin calls left and right. The movements, what the pound Swiss did, what the Euro Swiss did, the Euro Swiss did a 4,000 pip move in less than 10 minutes. The US Swissy, a 2,000 pip move. The pound Swissy, a 3,000 pip move. And you think that that's not going to have ramifications? I mean, the Swiss National Bank, these three idiots that are out there, because there's no other word for them, you do not make that type of decision without preparing the market for it. You know, when the IMF chairwoman came out, basically, you know, Lagarde, and they interviewed her, she said that she would have appreciated if the central bank president of the Swiss National Bank, Jordan, would have notified her, but she thought that he had notified other central bankers, which he did not. And what he did was cover his interest and that of his countries. The first one to throw the stone is the first one to be better positioned before the Great Recession hits. What this is doing is that it is basically positioning the global markets into a Great Recession. Some countries will enter into a Great Depression. Come next week, when the Euro Central Bank has to address quantitative easing, make no mistake, they're going to implement it aggressively. They're going to dump money into the system, and that is going to cause inflation for them. Now, before, because they had this peg with the Swiss franc, to some degree they had some protection so that their currency, so that the euro would not become more unstable. Now it is become a bomb ready to explode. So what is going to happen, and what you can expect in the next few weeks, is that they're going to throw everything they can to try and stop the bleeding in the market, especially in the euro. The euro at this time, based on what has happened, is going to eventually depreciate more and might even reach parity with the US dollar. That's a very dangerous statement, but it's what they're expecting and it's what they're preparing for. What just happened to the euro is what just recently happened to oil. Now, this is a domino effect. Again, these things happen. And in these domino effects, you have a series of events that are financially catastrophic. When the Saudis decided to basically destroy the value of oil, they've affected economies worldwide. They've affected oil producers. Russia is in dire straits because they were very dependent on oil sales. The ruble, the Russian ruble, collapsed yesterday even further. Why? Because it was dependent on oil. The Swiss National Bank decided to eliminate their trade between the Swiss and the ruble, so that pair was basically blocked. This is something that has been prepared with time. These are not things that happen, instantaneously. So you have to understand that what we're seeing right now is the domino effect in place. Someone initiated this, and we have not finished seeing the remaining part of damage that will come out. So the only thing that we can do is prepare ourselves for opportunity. Opportunity to make money in this market if you have the right tools and the right information. So when 15 major banks across the globe start saying that FX reserves have been affected on a global scale by them, make no mistake, this is a severe, severe nightmare of the worst kind. Now, in 2008, we saw this. What happened? Everyone pulled their forwards. What is a forward? A forward contract is when someone is already committed to buy a certain currency at a certain price in the future. And so it doesn't matter how the market is trading, there are commitments, within the market. Well, now you have all the exchanges worldwide basically running for cover, and there aren't enough parachutes. And so they're trying to reassess real quickly and reevaluate how they can rebalance their positions and their FX, their foreign exchange positions, which is what I call currency portfolio rebalancing. Unfortunately, the Swiss National Bank didn't give anyone the opportunity to rebalance their portfolio correctly and their risk with their foreign exchange. And so what's going to happen now is that that's why you're going to see right now, if you were watching the Asian session, you saw that the Nikkei crashed yesterday afternoon. It was a bloodbath. You're going to see Wall Street today, the Dow, the S&P, the NASDAQ, the Russell, come down in flames. And all this because of all the exposure that these multinational corporations have outside of the U.S. This has become, right now, a serious, serious nightmare. Now, granted, there's a few people out there that have made money, but there's a lot of people out there that have lost money. So for those of you that have accounts here with FXCM based on their current announcement, my suggestion is be smart, pull your money out. Don't wait for them to come out and saying that they can't comply with the new capital requirements that CFTC and NFA are imposing on them based on their $225 million loss. That's a huge loss, ladies and gentlemen, a huge loss. Think Forex announces robust financial position following the situation. This company, and very few companies are coming out with statements like this, that they were not affected by the Swiss National Bank debacle. This carnage affected a lot of brokers, but some of them were not affected by it. And so basically, you're going to see a reduction of broker-dealers out there. And that's the word on the street. When the Swiss National Bank removed the cap against the euro, that was something that no one in the industry was anticipating. This was one of those things that literally caught even the insiders by surprise. Make no mistake, this move will have consequences, and the Swiss will eventually pay for this treachery. The Swiss National Bank does not realize that what has just happened and what they did is something that you don't do. You do not throw everyone under the bus. It comes back to bite you. So this financial earthquake that they've caused, because that's what it is, it's a financial earthquake in the Forex markets by them abandoning their cap. Now, in no way were they obligated to sustain the euro by being pegged and not allowing the euro to go below 120 against them. Make no mistake, they were not obligated. That is the last thing that they was obligated to do that. What they took was a stand of protectionism. They took a stand to protect themselves from further loss, because they knew that if they stood with the euro come next week, the devaluation would affect them even further. So sometimes it's better to take your coins off the table, because it takes two to play chess, ladies and gentlemen, not one, and basically let the chips fall where they may. This, unfortunately, it affected the Forex world in a huge manner. Metatrader 4, and let's talk about that platform, because that platform is one that globally everyone uses, has a secure mechanism in it and my friends were explaining it to me, risk managers, and they were telling me that that once it gets to a certain level, a spike gets to a certain level in price, it shuts down. And that's why it shut down for an hour. However, the banks themselves decided to stop trading for 1 hour because they couldn't stop the floor. If they would not have stopped, then you would have seen, instead of a 4,000 pip move on the Euro Swissy, you would have seen an 8,000 pip move on the Euro Swissy. So the fact that all trading stopped across the globe is a good thing, but yet a bad thing. It's good because it didn't cause any more carnage. A bad thing because it did. It's initiated a domino effect that we will see more broker-dealers, more banks go down. So there will be less liquidity out there. Make no mistake, we are in a financial war of the highest order. It was already been declared, but now there's no hiding it. Now you're going to see some serious maneuvering financially by the central banks to protect themselves from their counterparts. This is not going to be one of those things that you're going to be able to say, well, is this something that I'm going to be able to really do? Yes, you are. Now I have a few questions here, so allow me. Can FXCM make payments to clients while they are in breach of their capital requirements? Yes, they can. They can because they have a lot of money still, and they haven't come out an announcement saying otherwise. So while they can, pull your money. Be safe, don't be sorry. You know, if they're able to comply with their capital requirements in the next few days, they should have come up with a statement yesterday saying, you know, we are going to comply with our new capital requirements. Not say we are going to discuss this matter with our regulators. The terminology that they used was not terminology that gives me or you confidence. I spoke to a lot of CTAs out there that basically got blown up. A lot of their clients lost money that they were managing because this caught everyone by surprise. A lot of EAs out there, people that are using those robots, which I've never really been fond of. If you're paying $99 for a robot or $200, come on, it's not going to make you rich. And basically, if you were in it yesterday, let me tell you something. As soon as that thing stopped your trades, it reactivated more. My friends that were running the risk management desk for a lot of brokerages were telling me that they were literally turning off these accounts because the EAs were initiating new trades, causing even more losses. Maybe they weren't affected too much at the beginning, but then, you know, when the thing starts to go wild, you don't have control over that. So a lot of these guys that are using these trading systems, you know, they pretty much lost their accounts. This has been a bloodbath of the worst kind in this type of environment. This has been a bloodbath that will be remembered for years. Believe me, in 2008, I was one of the very few to actually forecast that the banks were no longer going to be loaning money, and my brother at the time was a mortgage broker, and this was 6 months before the subprime mortgage hit. And I walked into his office and I told him, Norman, sell everything. Finance what you can and get out. Get out of the business because this is going to blow up in your face. You're not going to be able to finance anything. There was a French hedge fund that came out 6 months prior to all, hell breaking loose, because there's no other word for it, that came out saying that they could not quantify the value of the portfolio of mortgages that they had bought. and that they were dumping them. And that triggered the domino effect. What we just saw here is the beginning. 6 months from now, you're going to see even more carnage. So that's something that what you can do is go, for those of you that have an account, you can go to their website and there is a withdrawal form. You can fill that out and they will have to send you your money back. Calling them, yesterday one of my friends who was a CTA was calling them all morning because he encountered severe losses and they wouldn't pick up the phone. That does not give me a vote of confidence. You know, I can't say I've never been fond of them. I can't say that I've been fond of them. This is a business. However, the fact that right now they chose yesterday not to pick up the phone was not a good thing. So my suggestion is call the NFA. Go to the NFA website and tell them that if you cannot get through, call the NFA. Go to the NFA website. It's nfafutures.futures.org and call them and tell them that you can't get through and that you wish to, and that you want to know what is their position with FXCM right now, because you have money there. You need to know this. This is a time where you actually get informed of what's going to happen, because if the regulators aren't coming out saying something yet, there's something wrong. A lot of companies got hurt, and the regulators in the UK haven't come out with a statement. The regulators in Australia haven't come out with a statement. The regulators in Japan haven't come out. Singapore, on and on. When the regulators do not come out with a statement, there is something wrong. It means that they really cannot assess the value of the damage yet. So, call the NFA and basically get as much information as possible on what's happening, because this is an earthquake that hit everyone on a global scale, and it is not going away. We're going to see the damage of this literally for the next few months. You know, at one point, rumor had it that IG markets was going down, that they could be the first, because they sustained a 30 million pound loss, which is $45 million loss. However, no one really knew that they had 400 million and that they were able to sustain the loss. A lot of broker dealers out there had a lot of money and were able to sustain the loss. Owanda, you know, which I've never really done business with here in the U.S., I've never had anything good, or I've never had anything bad to say about them, because I've never had an experience with them before. You know, they came out with a statement which I thought was very important, and I'll pick that up in a second. Let me see where it was. But their statement was actually very, very good. Brokers News. Let's see. Important announcement. No, it wasn't here. I'll find it for you. But they came out with a statement saying that they were going to honor trades. A lot of broker dealers out there, bucket shops, basically said that they were not. That anyone that was in a Swiss trade was not going to get, and that was positive, that were making money, was not going to get paid. They were not going to honor that trade. How can you not honor a trade, but yet they're willing to take your losses? How can you not honor a trade? And so that in itself tells you how bad the damage was. That's serious. So, you know, we have to really address this, because this is something that is going to affect our business for the next few months. That's the bottom line. You know, it's going to affect the business for the next few months. Question: does it make any difference if I have money at FXCM UK instead of FXCM USA, or is it one big family? If you have an account at FXCM UK, then they usually have a segregated fund over there. So my suggestion is that right now, because of the loss that they've had, your funds in the FXCM UK are actually more protected than your funds would be here in the US. Because here, foreign exchange accounts are not in segregated funds. Only futures accounts are in segregated funds. This is a problem that we had at PFG with a lot of our clients. When PFG went down, a lot of our clients that had accounts in FX basically were left hanging in the wind. If it wasn't because they put a fight against the regulators and the trustee, they would not have gotten anything. Because Wassendorf did not steal money from the foreign exchange accounts that were at JP Morgan. He stole money from the futures accounts that were at US Bank, which were segregated funds. So in your case, the UK implemented different regulatory policies that would allow them to put money in segregated accounts, which is to your advantage. So, you know, again, FXCM has not come out with a statement saying that they are complying with the new capital requirements. And that makes them dangerous. That makes them, that makes their exposure big. As a broker, the one thing that we were exceeded by our compliance department, by the NFA, by CFTC was full disclosure. They have not really come out with full disclosure, especially after the atomic bomb that the Swiss National Bank dropped on the market. You have to understand that what happened right now was probably the most catastrophic event that we're going to see, or that we've seen in the past 10 years. Remember, my whole theory of currency portfolio rebalancing is that money must be in continuous motion. It cannot stop. They stopped it for 1 hour worldwide. 1 hour. Have you any idea how significant that was? That for 1 hour they had to stop to basically, number one, stop the losses and the bleeding that were happening financially. And two, to try and salvage what they could of the industry, because otherwise it would have been, a free fall of catastrophic development. It was to this day right now. One day after, we're starting to see that Alpari is out. We're starting to see that Excel is out. Excel markets in New Zealand. However, fortunately, they have their monies in segregated accounts. So even though they do not have the capital to continue working, because they are under Australian regulation as well, they had their clients' monies in segregated accounts, and so clients are still able to withdraw their money. This is a statement that even though the company is out of business for the time being because they lost their capital requirements, is a statement of confidence. Because if they ever come back into the market, which they will, everyone will want to open an account with them because they thought of their clients first. This is a statement of confidence. This is a company that if it came back, if I was able to open an account outside of the US, I would open it with them. Owanda gave me a vote of confidence. ILQ gave me a vote of confidence. Tier 1 FX gave me a vote of confidence. I spoke to these guys. I know where they stand. And I know that they got hit, but they didn't get hit hard enough the way everyone else. Alpari was a huge company. Ladies and gentlemen, Alpari, when they left the U.S., they left because there was no business here. I don't blame them. But at the same time, you have to understand that the amount of money that they were making outside of the U.S. was just huge. And they just got eliminated from the game. FXCM needs to come out with a statement, and the statement that they're coming out with is not good enough. So my suggestion, call your regulators. If you're in the UK, call the FSA over there in the UK. If you're here in the US, call the NFA. Get your money out. Be safe, don't be sorry. Do it now, because otherwise you may be too late. And this is unfortunately what's going to happen now. This, again, as bad as this got, it will get better. It will get better for us, because this market has now brought in an injection of volatility and protectionism that will create trades and opportunities that have not been seen for a very long time. So if you have the right technology and the right information, you're going to be able to make very good trades. You're going to have good management skills, good risk management skills, and your exposure will be minimal. That's what this is about. So since I know a lot of you wanted to know, was our technology basically in line with them? It was, and I'm going to show you shortly. One more question here. Okay. That's true. That's true. And one of my colleagues says, remember the Greek crisis and our clients losing half their accounts. Very true. When the Greek crisis hit, the amount of volatility was huge, and a lot of people lost half their accounts. How do we protect ourselves going forward? Peter, basically at this point, can you hear me? Sound back, okay. Basically at this point, we trade smart. We let everything settle. This is going to take about a week for things to settle. Thank God the weekend is here, because we're going to know more information come Monday of who we can trade with and who we cannot, who made money and who did not. And I can tell you right now that the only ones that gave me a vote of confidence based on the conversation that I had with them, ILQ, which is in Australia, Tier 1 FX, that's in Cyprus, Owanda, based on what they've come out saying, Think Forex, IG Markets is doing well. Who else? There were quite a few that came out actually, those announcements, and FXCM was not one of them, unfortunately. Let me see, let me pull this up, give me 1 second. There were a few brokers that came up with good statements that I was very happy with. I think Forex came out, that was Frank National Bank, oh, here's another one. You know, Dukascopy came out, with a statement as well, and it was a good statement. I would do business with Dukascopy, but they're a very big firm, very, very big firm. They're not small, but they're outside of the U.S. So, unfortunately here in the U.S. we're very limited. We haven't had a statement from MB Trading, which is something that I was looking forward to, because we don't know where they stand right now. When only one or two of them, Gain Capital has not come out with a statement. They've been very, very quiet. And when broker dealers don't come out with a statement, it means they really don't know how hard they've been hit and how the floor has been shaken where they're standing on, which is not a good thing. So, when we start to assess how bad is the damage, it's going to take weeks for that to happen. We're still going to see more FX broker-dealers basically blowing up. We're going to see more retail traders announcing the losses that they've had, and that reduces the pool of liquidity significantly. But like I said, the banks are going to continue right now because they have to rebalance the total loss and try and balance out by this was a transfer of wealth of the highest order. Make no mistake, someone made a tremendous amount of money in every level. So now you have to look to see to who by accident made wealth so that you can trade with them, because they're going to be, one of the strongest ones in play. And so from that perspective, that's what you do. Here in the US, Wanda, word on the street is that they made a lot of money, a lot of money. So not only did they make money from the losses that clients had, and they're forgiving them. The statement that they came out is that they are forgiving them the debits. When a company comes out with a statement like that, that's a vote of confidence. But word on the street is that they were positioned the right way and were able to take advantage of this situation because it was not intentional. Now, was no one looking at gold? Seriously? Gold and the Swiss are pegged. Gold was in position to go long. I was looking at it Wednesday afternoon that it was going to go long at least $10. It made a $30 move. It's amazing how a lot of these companies were not really looking at what the metals were doing and seeing how they were positioned. Question. Wow, they must have made a ton of money if they're forgiving clients losses. Exactly. They made a ton of money if they're forgiving clients losses. Like I said, one of them made $250 million in one day. That's a lot of money. I can't tell you who it is, but let's just say that the ones that are coming out strong made out like bandits. And that gives me a vote of confidence to do business with those, with those broker-dealers, and not with those that basically are just not coming up with statements. Unfortunately, that's just the way it is. So I want to go to the charts real quickly because I think it's important that we, go over what happened. And I'm going to pull up the dollar Swiss first, and then we'll look at the pound Swissy, and then we'll look at the euro Swissy, because it's important to really see how this played out. This was very significant. And anytime that you have a specific currency that is taken out of balance the way this one was, make no mistake, it's going to tear right through every parameter you can imagine. Okay, this is a Swiss. As you can see, the drop was right here. It was horrendous. I mean, the total move on the Swissy, from top to bottom, this thing was just huge. From the get-go, 1,527, but in actuality it was more. I mean, this thing came down close to 2,000 pips, 1,828 pips. Now, what everyone wants to know is, was there a signal before it happened? And there was. I'm going back to it slowly because I want you guys to see where it was. Okay, this is where it began. I'll go back one more. So this is right before it happened, but it was on the 15-minute that we got signals. Some were on the 10, some were on the 15. It was amazing. As I've told you, the time frames that we use to identify some of these trades are really unique, but I'm going to show you gold, how gold was positioned, because no one was looking at gold, and gold was a key factor in this. Now, granted that if you see a trade in gold that is setting up to go long, anticipate that the Swiss is going to get stronger. No one was anticipating what was going to happen. So let me go back here. Okay, let's move forward. Right here. You see this? You got the signal on the 15-minute, an hour before it happened. We got the signal 1 hour before it happened. You had 1 hour to short the US Swissy. That's powerful. Very, very powerful. So if you would have been using our software, which some of you are, you would have seen this trade if you weren't in other trades that looked better, and you would not have gone long. You would have shorted this thing. Now granted, the initial move was huge. I mean, it was one candle. It was one rip. And then it just gapped. So it was a 400 pip drop out the gate, and then it gapped. And when it gapped, everyone pulled their forwards. As soon as this happened, this spike happened, this is exactly when all the platforms initiated what we call a security measure, and basically just stopped. But the problem was that it wasn't just this gap here. It was the fact that other currency pairs were affected. And so when you have too many currency pairs going wild on you, then the platform will just stop. And that's what happened. Everyone's platform just stopped. So unfortunately, in the FX, we have that mechanism where in the stock market, if you remember what happened to Knight Capital a few years ago, 2 years ago, one of their algorithms started a selling process, and they basically just drove the market straight to the floor. The amount of losses that they had were in the billions. And we've had losses in this market in the billions. In the billions. However, at least our market was willing to stop the carnage. So the bleeding stopped. So yes, it stopped the crash. And that's what it was. It was a flash crash. This was not a high frequency trade. This was, a trade that basically just all algorithms, as soon as they saw that the peg was removed, just by statement, boom, that was it. They just pulled every bid off the table, and it was offer, sell, 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 sell. And that's what it was. And if you were on the wrong side of the trade, let me tell you something, it was not a good day for you. Because not only did you lose your account, you owe money. And my concern is that FXCM, with their statement that they're coming out, is that they're going to try and collect. That means that their loss was very significant to them. Where Rwanda's coming up with a different statement saying that they're going to forgive people for that loss, for the debit. I'd be like, whew, wow, So you got the signal on our software 1 hour before it happened. Let's take a look at the pound Swissy. And we have that one. Where is that thing? I know I have it here somewhere. Did I bring that out? Or is it just the Euro Swissy that I brought? Oh no, here it is. There's the pound Swissy. And then I'm going to show you gold, how gold set up. It was amazing. Amazing. That's the one thing that, with our software, you're able to use it to analyze Forex, futures, and even stocks. You can trade stocks with it. I don't trade stocks, I like futures and I like Forex. So look at this gap. I mean, again, it was just amazing how this thing just ripped right through every level of parameter you can possibly imagine. Almost a 3,000 pip move, 2,874, almost 2,900 pips. Now again, the question here is, was there a signal before this happened? Yes, right there. There were the power dots. This algorithm of the power dots basically tells you that there is a tremendous amount of momentum and volume that's about to enter the market. Now, I want to show you something. Look at the volume. This is where it becomes interesting. When you start looking at the volume, because our volume indicator is very unique in that it isolates, how much buying and selling there was. Look at this thing. This candle, the first candle, 129 million sell volume against 128 million. The previous candle, 147 million on the sell, 127 million on the buy. They were selling aggressively. The previous candle, 125 million on the sell, 100 million on the buy side. This next candle on this power dot, 116 million on the buy side, 135 million on the sell side. And this next one, 102 million on the buy side, 106 million on the sell side. But what this did, when you see that they start selling aggressively on the 15-minute the way they have been, and you see the power dots, you don't go long, you short. You use your risk management to assess your risk. You put a stop loss above here, 10, 15 pips if you want. And my thought is that they were going to come here to 153.92, which was basically about 150 pips, not this move. The initial move was just out of control. So you got the signal 45 minutes before it kicked. 45 minutes before the trade unfolded. To me, that is worth a lot. That is worth gold, because our volume indicator, and you can see how the volume started to increase here. You see how it starts to increase here? The frequency of order flow was increasing, but the candles weren't moving, because what they do in these small candles is that they rebalance within a small range. I have a question. Which could be the difference between buy volume and sell volume to consider aggressive? Oh, good question. Well, on the 15-minute, if ever you see that in a small candle like this, for instance, and these previous two candles right here, look at this. This candle didn't move, and I'll make this bigger for you so that you can see it. This candle didn't even move a pip, and look at how much volume they put into that. 100 million on the buy, 125 million on the sell. That means that they had a difference of 25 million that they could not offset. When they begin to rebalance before they actually take the trade short or take the trade long, they start to aggressively increase their volume. That was that candle. This candle, 127 million on the buy side, 147 million on the sell side. There were 20 million that they could not fill. Now, why didn't this candle right here, and let me, use the pointer, why didn't this candle go short? Because they were offsetting their long positions before they took it short. This next candle didn't really move a lot. If that, maybe 5 pips. 128 million on the buy side, 129 million on the sell side. And that's all it moved? Are you kidding me? See, our technology takes you to the next level. It's the final frontier of volume, spread, and volume price analysis. Because we do not depend on the open, high, low, and close of a candle and use a moving average to determine what the volume is doing. Oh, no, 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 no. We go above and beyond. We isolate every order that's being reported by the banks through a bridge, which is an aggregator, to the broker-dealer, to the platform. So we take into consideration every order. What was the total volume in this? Total volume in this one, 60.7 million. That doesn't seem right. Oh, actually, no. Forgive me. I'll tell you right now. Total volume here in this one was 257.7 million. However, if you see, they had 128 million on the buy side, 129 million on the sell side. There was a difference of 1 million. So they were getting ready. For 1 million, they're getting ready to turn that thing and literally dump it. This next one, 116 million on the buy side. Look at that. It's not even a candle. It's barely a wick. Not even a pip, half a pip if that. 116 million on the buy side and 135 million on the sell side, a difference of 19 million that they could not offset. They were trying to get out. They're signaling, we are getting out. Now, granted, if they're putting out offers, because they're trying to get out of these positions here, that means that they know that it's going to just explode. And no one is taking those offers. That means that they're not going to buy at this level anymore. They're going to dump. This next one, 102 on the buy side, 106 on the sell side, a difference of 2.9 million. Because some orders come in smaller than others. But here, again, they were only willing to buy 102 million of the total orders that were out there. A difference, really a difference of 4 million, not 2.9. However, there are orders that come in which are not, complete. They're half orders, And so basically you had a difference that was not filled because no one was willing to buy at this level anymore. And then this one hit. Now this one was special. And you can see why. Look at the volume on this thing. There was no volume. 25 million on the buy side, 42 million on the sell side. Are you kidding? How ironic is this? This thing had no volume. They pulled everything and just let it crash and settle where it may. But here, this little candle had more volume than this one. I mean, is that even possible? No. It doesn't make logical sense, but our technology isolates that information and gives you the edge to take your time assessing the direction of the trade based on how they are manipulating their volume inside the bar. You're getting what we call inside the bid and offer. That's what you're getting. You had plenty of time to assess that this was no longer going to go long. They were going to crash it. Now, if you were trading off of the moving averages, then ladies and gentlemen, and I put these moving averages here on purpose. The first one on top is the 50, the second one is the 100, and then this third one is the 800. If you were taking trades off of this, you got slaughtered. Literally slaughtered. You were not happy at the end of this trade. So the reason why we don't use moving averages is because they are lagging and because the banks have counter-programmed against price action. Why? The candles, the moving averages are dependent on price action, on how much movement a candle moves. That is how they plot. Well, if there is no price action in the candle, but there is volume that's being rebalanced in the candle within a 1 to 2 pip range, that's not going to affect the moving average. In no way can you see what's going to happen. That's not going to give you an edge using stochastic MACD RSI. You do not have a clear picture of what they're doing. That's why our indicator, our proprietary indicator, and the algorithms that we're using, we are tapping into the protocol that they use to rebalance their risk, their portfolio, and their decision process. Their algorithms cannot hide the information from us any further. Their algorithms cannot deceive our decision process and can only give us an edge to make the right decision when we execute our trades. I have a question. Closing in the middle with aggressive sell volume. Okay, yes, basically narrow spread up bar, closing in the middle, narrow set. This one right here, is this the one you're talking about? Or this candle right here? I'm trying this one. Okay. So this one right here had 116 million on the buy side, 135 million on the sell side. So what happened here is that, and always take into consideration that the one in control is the one that is selling the currency, not the one buying. He can bid all he wants. But if the owner of the currency doesn't wish to sell, there is nothing. But the indication of weakness to offset those trades any higher than that basically is what told you they're done and they're getting ready. But you literally, as soon as the power dot appears, you have to look 2 candles previously to it to see how they started to initiate. And you can even do 3. Look at this one. This one had a pivot. However, look how small it was, and look at the volume. 144 million on the buy side, 116 million on the sell side. Difference of 29 million. Did it move? Not at all. This next one here, 100 million on the buy side, 125 million on the sell side. This is the one that basically said, we are now interested in offsetting our long positions. We need to get out. Who's going to take it? Who needs to buy right now because we need to get out? So they dump aggressively. This next one, 127 million on the buy side, 147 million. Look at the increase from 125 on the sell side to 147 on the sell side. That's you're seeing the emotion of the market right here. You're seeing the emotion of their necessity to get out because they need to get out. Now, granted, none of them knew that the Swiss National Bank was going to dump. However, if you had this information, would you continue to go long? The answer is no. You would not. So when it crashed, which is this, it went from here to here, there were no bids. It was all offer. And they dumped it from 151 to 134.90. That is where the carnage began. And that, it's like if you were trading futures and you have a limit down. There is no way that this currency is going to come back up. This pair is going to come all the way back up here. So anyone that was caught on the wrong side of this trade and was long literally got slaughtered. No question about it. Now, could you have seen that with a regular volume indicator? The answer is no. You would have never seen what was about to happen except by using our technology. So now let's go to the Euro Swissy, because this is the one that really did the doozy. This is the one that made a difference. This is the one that everyone is basically screaming foul about. And quite honestly, yes, the Swiss National Bank should have given some warning. It's called professional courtesy. And make no mistake, central bankers of other nations will remember that the next time that they decide to implement policy. And payback is, is one of those things that you can't avoid in this industry. It comes back and it haunts you severely. Let's go back. Look at this. We got the signal on this on the 15-minute out the gate. As soon as it closed, this was just ridiculous. And then it just dropped a level and it continued. And it just got nasty from that point on. See, I mean, they completely distorted the chart. I'll try to go to the 10-minute here for you, but I mean, the Euro Swissy was just one of those where, you had no business trading it long. If you were trading it, it's not one of the pairs that I trade. However, I would have been probably in the US Swissy pair. That would have been the trade that I would have been more inclined to look for, because I was looking at how gold was trading. And we're going to look at gold because, make no mistake, when you see how gold was positioned, there was no way that you were going to take a position on these pairs long. Not in a lifetime. And if you did, then you didn't know what you were doing and you exposed yourself and lost, unfortunately. See, here on the 10-minute, you didn't get a signal. It was further, it was here that you got it, and then it just went flat. Unfortunately, this one just, the Euro Swissy, like I said, is not one. The Pound Swissy was great, and the US Swissy, the signals were awesome. Now I want to show you gold, because it's important. These are commodity-based currencies. The Swiss is a commodity-based currency, and it's always been to some degree in correlation with gold. So when it's correlating, you want to take a look at that. And when it's not, then it's not, But our technology basically allows you to see that information. I'm going to take this back, and it was here. Now, you see this line right here? This was identified on the 60-minute, but I'm going to take you, and so this price level is identified by power dots. You see how I drew this red line here? It was also identified by power dots previously. So this is a price level that, look at how at the open they started to trade, not even close. Every time they came close to it, they pulled away. And you can see that even with their volume. Here, I mean, you can't really see a volume bar, but let me tell you something. The volume here was just huge. Because, for instance, here, look at how many orders on this candle, how many contracts. I mean, and you can quantify this per million if you like. 432 million on the sell side, 425 million on the buy side. And look how small that thing is. Are you kidding? Look at this previous one. 366 million on the buy side, 483 million on the sell side. A difference of 117 million, you could say. And it's not going to break through this price level? Are you kidding me? This one here. 381 million on the buy side, 806 million on the sell side, 425 million, and you're not going to break through this level? Are you kidding me? So when you start to see and analyze the volume here, it just takes you to a whole other level. Let's look at this bar right here. Look at how much volume they put in this one when they just when this is when it hit. This is when the announcement kicked in. This was in the billions, okay? 3,592 orders hit in the millions. Okay, this is, you could say it was a 3.592 billion move on the buy side against a 2.489 billion move on the sell side. You're talking about a difference of 1.1 billion, and they exploded. Now, in futures, we use the 45-minute, and I'm going to show you why. because in futures, the 45-minute has been extremely accurate identifying and forecasting these moves hours in advance. And this is something that is very important for you to see, because in FX, you don't necessarily use that time frame to identify the trades, but in futures, we do. And you can identify how the E-minis are going to start playing out, how the Dow, how the NASDAQ. Look at this. This was the day right here. You have this level identified previously by a power dot, and look at the power dots here telling you, no way are we going to breach this level. Not even close. I see this type of movement here, this type of setup, and I am excited for the outcome, because I want to throw the kitchen sink at them and even borrow my mother's to throw it at them as well. I mean, this is just confirming this. If people would have looked at gold and then looked at the Swissy, they would have said, no way is a Swissy going to go, going to hold that price. They're going to do something. Maybe not too aggressive, because no one really knew how aggressive the move was going to be, but it was going to be extremely aggressive. And that's exactly what happened here. It was an extremely aggressive move. So, based on this information, and look, for 2 days, they didn't break this level to the downside. They held very strong. They went up, came right back down, nothing, not even close. This is what gave them away. As soon as the power dots started to form and were continuous based on their volume activity, this identified that their frequency of price level had changed and that they were going to go long eventually. Question. Even the mother-in-laws think too. Yeah, indeed. So yes, what this did is that it identified the floor, confirmed it from every level. Now let's take a look, so I wanted to show you this because it's important, when you're looking at futures. But let's go down, let us pull the market analyzer. Let's take a look at the E-mini, and you'll see how the S&P comes out in the 45-minute. It's very fascinating, believe me. The technology that we have created is created based on the protocol on how the banks report their data to the dealers. Very complicated algorithms, but very effective at decoding volume price analysis. And that's what we advocate here, because we give you cutting-edge information where it gives you time to evaluate your risk, evaluate your entry, and even evaluate your exit. Not that many programs out there do that. Now, this is not one that will execute trades for you. No, you have to manually execute your trades. You're in control, because what happened yesterday is everyone that was using a robot got blown up. Their accounts exploded. And they exploded in levels that were no longer recoverable, unfortunately. So let's give this a minute for the E-mini, for the S&P to come out. Come on, populate already. But what I wanted you to, here it is, okay. So this is the 45-minute. You see how it identifies these levels? Nothing here, but you see how it identified this level that it was going to go short, and this level that it was going to go short. They went up, but if you would have drawn a line here, for here, as soon as they went below it, this was what happened during the announcement on the S&P. It just came down, went back up, and then it came down again. This was the level it identified. Literally at 6:30 a.m., they came down. There was no tomorrow. Tomorrow did not exist. So when you look at it from that perspective, you're welcome, Tom. I'm glad that you were able to join us. I'll give you a call. When you're able to see this, it changes the whole gambit of how you trade. Let's look at the Dow. You're going to see the same thing. So if you're looking at this, it is really amazing because it changes your whole perspective of what the market's doing. It gives you the insight that you need to trade. That's why I'm saying great disaster also creates great opportunity. We are going to have great opportunity right now with the amount of volatility that's about to enter into the market. Now granted, there are brokers that are going to go out of business, and there are traders that are going to go out. See this level right here? It identified it here on the Dow. This is going down. It came up to it, and then at the open, bam, it's in a downward spiral. I'm going to draw this line so we can see it in a smaller time frame, but you're going to see how they traded against this level. It's not the one. Come on, let me color it. Okay, we're going to go down to the smaller time frames now on this one. So yes, this is something that's going to change the way you look at the markets forever. And this is one of the things that will make the difference for you. Bottom line is that it comes down to, can you make money in this market knowing that it is rigged? The answer is yes. Look at how this is a 10-minute. So this identified they were going to go long. They came right to this level, and look how they came right back down. Now the moving averages are here, and would you have made a decision based on the moving averages? The answer is I would not. Not even close. Not even close. But now you know the range that they're trading in right now. You know, this is, and if you understand the range, then basically you're not going to take a trade in the middle, are you? That's 14 points. 14 points. So this thing, as soon as they came up in the open, it came down almost 14 points. That's huge. That is huge. So yes, it makes a big difference. A huge difference. So now what you have to make the determination is, how do you move forward? How do you continue? And that's the question that we're all asking ourselves right now. How do we move forward? And this is the one thing that I cannot do for you. I can only help those of you that wish to help themselves. But what I am going to do is that next week I am going to start to trade the European session again on Wednesday night, which is a Thursday morning for me. And we're going to start to trade live. And you're going to see me take these trades. And you're going to see how this software basically gives you that edge. And that's all that matters. At the end of the day, you know, can I make this functional for you? Yes, I can. Can you make this functional for you? Yes, you can. Yes, you can. This software is not complicated for you to understand. The algorithms are complicated, but the software is not. This sentiment indicator, it's not a leading indicator for me. It's a confirming indicator. It's late. It lags. It's okay. I use it as a visual. This indicator, the same thing. It's not a confirming indicator. You know, the radar, it's a lagging indicator. Why? Because it's affected by price action, not by volume. That's the difference. This indicator, these power dots, is by volume and how they are rebalancing their orders. And that's what makes the difference. So for those of you that are interested, you can contact me. I will put my information here for you. You can send me an email and we can go over how you can start using these tools. I do a 3-day training. I spread it out over a week's time because I give you homework because I need you to really understand what you're doing. But at the end of the day, you're going to have the same knowledge that I have, and that is going to make a difference for you. If you're outside of the U.S., you can Skype me. I've had this Skype for years. If you're in the U.S., you can call me. Or if you want to call from outside of the U.S., then call me. Of course, I'm more than willing to take your calls. So you have my email, you have my Skype, and you have my phone number. I look forward to hearing from you. I look forward to seeing you on Monday. Monday morning will be very interesting because there will be more news, and I will have more news to report from you from my friends inside the industry and let you know basically who is standing and who isn't. And hopefully we'll have an idea of the type of damage that is still out there that has not been quantified. So I want to thank you very much for joining me today. Indeed, it has been a very interesting past 2 days. I have to admit that it's one of those things that we just cannot look away. So don't forget, join me on Monday. I promise, what trades we could not find today, we will find Monday morning. Today was really not a day to be looking for trades. Today was a day to really be assessing the damage that was